Hey there, Brad Casher from GreatOptionTradingStrategies.com. Got a little trade management case study for today. In today's video, I'm going to go over an important put selling and covered calls for income trade management issue, and that's when does it make sense to accept partial profits on a trade? Now, I'm not talking about leaving a little money on the table. I'm talking about leaving a lot of money on the table, which is what we did last week with one of our trades. So I want to go over that and show why it really did make sense. Before we get into that, I just want to quickly tell you about a number of free resources I have over on the Great Option Trading Strategies downloadable library page. I've got quite a few ebooks, special reports, and strategy guides available over there. And depending on where you are in your option trading journey or your personal finance journey, you should be able to find some resources that matter to you. And you can find a link to those resources in the description section. Two of the most popular downloads are Trading for a Living, My 4 Rules, and Options Are Easy. Stop stressing and learn what options can do for you. Trading for a Living is perfect if you're in retirement, nearing retirement, planning for retirement, or even wondering if early retirement is for you. And if you're new or relatively new to options, you really need a quick and easy guide to the nuts and bolts of option trading. So you're definitely going to want to check this one out. Options are important risk management and return enhancing tools that every self-directed trader and investor, yes, investor, needs to understand and be able to use. And this user-friendly 10-page guide will have you up to speed in just minutes. Okay, so let's get back to it. So last week inside the Leverage Investing Club, we closed our 10th winning trade of the year. And last year, 2025, we realized profits on all 46 trades we closed. Okay, on the surface, the put selling trade we closed last week on Boston Scientific at the $70 strike price was not that spectacular. Our final returns were just 12.63% annualized over 16 days. That's in contrast to the original projected returns of the trade, which had been 24.19% annualized over 17 days. In other words, we refunded Mr. Market about half the premium he originally gave us. That's definitely not something we typically do. Now, I know there are some mechanical trade management processes out there that are currently in vogue that says you should arbitrarily close a trade once you're able to lock in 50% of your max gains. We don't do that. That's because we have a far superior trade management process. It's based on understanding the underlying principles of option selling, taking everything on a case-by-case basis, and then, gasp, making informed choices. I get the attraction of the mechanical approach as it takes emotions out of decisions, but two counters to that. Number one, any area of your life that you're especially proficient at, that you're really good at something, I guarantee you, you're making informed choices, not mechanical decisions. And number two, you should also be skeptical of anyone who tries to convince you that the same mechanical rules work equally well on each unique trade, let alone in any and every market environment. And you know what? There's also another method to remove emotions from the decision-making process. It's called having clarity. Again, consider all the areas of your life that you're proficient. You don't need rigid mechanical rules to excel because you understand those areas of your life and what constitutes a good decision and what constitutes a bad decision. So let's look at the decision we made to let Mr. Market off the hook and allow him to only pay us half what he originally owed us. Why did that actually make sense? Because we're definitely not in the business of giving Mr. Market a break. Well, it was very simple. The technicals concerned us. In fact, the timing of anything we do with an open option selling trade, whether we exit a winning trade early or whether we're repairing a trade that's gone the wrong way on us and we need to know when to roll or adjust, comes down to just two factors: remaining time value and basic technical analysis. Now, in this case, it wasn't because of the remaining time value, because as we've already seen, there was still a good amount of time value left on that Boston Scientific $70 short put expiring after the market closed the next day. But let's look at that remaining time value factor anyway, because it's important to understand. Now, the reason why there was still a good amount of time value left on the expiring $70 put is because the stock had been trading lower on us, or lower than we expected. Also, implied volatility levels had spiked across the board in the wake of the U.S. attack on Iran, but it was mostly about Boston Scientific trading $2 to $3 a share lower than where it had been trading when we first entered the trade. In a different scenario where Boston Scientific had been trading $2 to $3 a share higher, we definitely would have closed the trade early and for considerably higher final annualized returns. In fact, the annualized metric is one of my favorite tools to help me decide when to exit a winning trade early. It's very simple. You just annualize how much you would leave on the table by exiting early. Or said another way, how much does it cost to close a trade and what would the annualized rate be on that between the current point in time and expiration? If that rate gets sufficiently low, you have to ask yourself if it's worth keeping the trade going to accrue at that rate. For example, if I'm only accruing the remaining time value in a trade at a 7 to 8% annualized rate, it really doesn't make a lot of sense to keep it open. First, there's likely much better and higher paying opportunities out there for my money. And two, I'm also not getting compensated much to give Mr. Market an opportunity to throw a wrench into the gears at some point. I've added links to a couple of annualized resources in the description section. One's to a video that does a deeper dive on the annualized metric, and one that goes to my website article that explains why I love the metric so much and what the actual formula looks like. But again, it wasn't remaining time value, but basic technicals that led us to exit the Boston Scientific trade early. So check out the close-up on the Boston Scientific chart to see what I'm talking about. As you can see, the $70 short put position had been trading in the money a bit as the stock traded below the $70 share price level for a few days. But then the stock quickly recovered and recaptured the $70 level, meaning our short puts were back out of the money heading into expiration. But then for 3 consecutive trading sessions, Tuesday, Wednesday, and Thursday, the stock kept getting turned back in the $71.50 to $72 range. And as you can also see by the upper wicks on those candles, the stock traded up to those levels at some point during the day, but then got pushed back. So in this case, the technicals were giving us a warning sign. The stock was clearly running into resistance, and that increased the odds that the shares could pull back in the near term. And that's exactly what happened, as you can see with the next day's price action, as Boston Scientific traded back below $70 a share once again to close the week and expiration at $69.48 a share. So we heeded the technicals and exited the trade one day ahead of expiration, and in the process left some money on the table. We originally sold the $70 puts for 80 cents a contract when the stock was trading at $73.79 a share. And then we ended up buying them back to exit the position for 40 cents a contract when the stock was trading at $71.11 a share. So all in all, not a terrific trade, but one that I felt we managed very well. We still walked away with double-digit annualized returns. We were able to exit a trade that didn't quite work out and avoid a repair campaign. And with the stock still trading below $70 a share into the following week, we're now well positioned to enter a new Boston Scientific short put trade when we see new signs of stabilization. Okay, if you enjoyed this and want more option selling resources, be sure to check out the channel's other videos and playlists and subscribe. We're just about to hit the 1,000 milestone, and I've got a backlog of other videos in the works. Also, sign up for the Daily Tips newsletter via the pinned comment below. The newsletter is a tremendous option selling resource and really complements the YouTube channel, as some topics are better suited in article format and some are better suited in video format. Both resources are about heads you win, tails Mr. Market loses. So the newsletter is a resource you're going to want. You can sign up directly, or there's a link in the description section below to the Great Option Trading Strategies downloadable library page that I already told you about. Download anything from there and you'll also begin receiving the Daily Tips newsletter automatically. Heads we win, tails Mr. Market loses. Let me help you come out ahead on virtually all of your trades. Okay, until next time.